Thank you so much for attending this webinar today and this Friday. My name is Ali. I'm the VP of Market Analysis and Education at Investlo, and I appreciate you taking the time to attend this webinar, and I value your time. I hope you enjoy and learn a lot during this session. Today we are going to talk about the Advanced Bollinger Bands trading strategies. You might have heard about the Bollinger Bands a lot because this is a very famous indicator in the MetaTrader 4, yes? But today I'm gonna share some secrets with you from the creator of the Bollinger Bands, which is Mr. Bollinger. Okay, so I hope you find it informative. Before we move on to our agenda for today, please let me know if you can hear me and see my presentation clearly so we can start shortly. Okay, excellent. So let's move forward. Thank you so much for your feedbacks. This indicator is not only valuable for finding trends, it also provides us with information about the stage of which the identified trend is. So we are going to use the Bollinger Bands to identify the trend. Also, we are going to find the trend reversal as Mr. Bollinger Bands is using it to do. Okay. Today we're going to talk about the phenomenon of Bollinger Bands. We'll see how we can create our own Bollinger Bands maybe. And then I will introduce you to the relative highs and lows, which is the cornerstone concept of the Bollinger Bands. It means if you want to use it correctly in the right way, first you need to know what is the relative highs and lows and why they are very important for us. Then we are trying to use them, these concepts of Bollinger Bands, to identify trend reversals, maybe a M top and the W bottom in terms of the Bollinger Bands. Okay, and to make it easier for you, I'm going to introduce you to two oscillators which are created also with Mr. Bollinger to make it very clear and very easy to use. That's the percent B oscillator and bandwidth oscillator. If you have heard about them or you have been using them for some time, please let me know, because that would be very actually exciting, and that would give me a clue how much go through the details for that. At the end of this webinar, we will put all together and just reveal a strategy based on the Bollinger Bands. During this session, you can just send me your questions. I would appreciate to answer if I know the answer. Okay, yeah, that's it. No, it will be what we are going to learn in this webinar. But before we start with the Bollinger Bands phenomenon, please be informed that all of the content that we are providing during our webinars are solely for educational purposes, because trading in financial markets depends on your risk appetite, your capital, or let's say the amount of money you have and you want to put in trade, and also the level of your experience is very imperative. So please don't take any of these information that we are going to share with you, any chart on the chart, maybe live chart, and all these strategies during this webinar. Please don't take it as any financial advice or something like that. This is only for education, because we firmly believe that the education is the main leverage of trading in financial markets that can help you to improve your trading journey and become a successful trader, and actually it can keep you on the winning mindset. So rather than putting more money, or rather than finding signals from the other traders, the best way to become a successful trader in financial markets is trying to educate yourself. Okay, because anyone can become a successful trader if they have the right tools and guidance, and this is the purpose of all our webinars here. Okay, let's start with the Bollinger Bands. What are Bollinger Bands? This is a technical tool actually innovated by Mr. John Bollinger in 1980s. You mean, so it has the age of more than 40, about the, yeah, more than 40 years maybe. Yes. And Mr. Bollinger is one of the pioneer traders and Wall Street, and he also has a book on this on the Bollinger Bands, described very well all the details about the Bollinger Bands, everything that you need to know to put it in line with your trading strategies. The name of the book is Bollinger on Bollinger Bands. You may like to search it, maybe on the internet, and you can find it and buy it or download it. To get a better understanding of Bollinger Bands, let's start with the moving average. Okay, our next step is to look for upper and lower limits above and below our moving average, and we will identify Bollinger Bands along the way. Eventually, based on these limits that we are going to talk about, then we can determine whether prices are relatively high or relatively low. So we are starting with the moving average, and the concept that the moving average can provide us to use to understand the direction of the market, and then we are going to find our limitation on price to measure the volatility, and then we will define the relative highs and relative lows in the market. Our first step is to add a measure to trend. Okay, and together we use a simple moving average, as you can see here on my presentation. Let me just switch on my laser pointer here. Okay, yeah, you see this is a simple moving average to figure out which way prices are going. 20 periods is a good starting point for seeing what's happening with the intermediate trend, what we are using right now. That's because we are trying to just highlight, please take it in mind that here we are just going to highlight the basics of the market here. We are not trying to get too sophisticated, and so we just want to know whether prices are rising or falling on average. And that's it. We are not looking for any signals to be generated from the moving average, no crossover, no bounce back. The objective is not to use it as a signal trigger, guys. Okay, so we don't care when price crosses above or below it, but as a useful definition of trend. This is the only objective that we have here, to use this simple moving average. Okay, simply put, when the moving average is rising, you see here this actually arrow here. When the moving average is rising, or it has a positive slope, as you can see here, the positive steepness, the trend is up. And when the average is falling, as you can see here in the continue of this downtrend, you see it has a negative slope right here. We say the trend is down. Okay, so that's it. Rising MA means trend is up, falling MA means trend is down. This is the only objective that we have from using this moving average. But let's move one step forward right now. We have the 20 period simple moving average, for example, let's say. So it's time to ask whether the price is relatively high or low, and what does it mean? As a way to answer this question, we are going to create intervals above and below the average. Here, we need a statistical actually variable to measure the volatility. A standard deviation is the most common measure of volatility, so we are going to use it to develop those intervals. But the standard deviation is a measure of how actually dispersed the data is in relation or in comparison with the average. I really don't want to get through the statistics and formula and the mathematics. This is very boring. Yeah, right now we just let's leave that, and we're just going to use the interpretation of the variable. That's it. Simply put, the lowest standard deviation means that are clustered around or very close to the average. Okay, it happens when we see the bands are narrow, and I'm telling, I will tell how we can create those bands. Okay, but back to SD or standard deviation. So the lowest standard deviation means data are clustered around or very close to the average, and high standard deviation indicates data are more spread out from the average. In terms of market language, that was the statistics, okay? But in terms of market language, a higher standard deviation indicates more volatility in the market. And this is what we really like to talk about. And the lower SD means a less volatile market. To create the upper band, we add double SD to the average, or let's say this is our middle band, okay, the simple moving average. The upper band is simply derived from the moving average price plus a variable called width times volatility. So we have the standard deviation as a volatility here, and we are going to use another variable as a width. Let's say a round number. Okay, volatility is a standard deviation of the same data that was used in the moving average as a calculation of this and the formula behind the Bollinger Bands. But the important thing is that the width is the number, is a constant value, or let's say, and typically it's the number of 2. And it could range from 1 to 3 depending on your application, but by the way, it means we are going to add 2 times standard deviation to the middle band, which is our simple moving average, okay? And this actually creates our upper band. As well, the lower band can be calculated as the moving average minus the 2 times volatility. Again, volatility is the standard deviation of the same data that was used in the moving average, which gives us the lower bands. Okay, as you see here, hence we have the Bollinger Bands already on the chart. By definition, they provide us with relative prices that are either relatively high or relatively low, or let's say they define high and low values on a relative basis. Okay, I tried to make it as simple as possible, but if you have any question regarding this, don't hesitate to ask. Just write it through a question tab. So the default length is 20 bars or 20 periods, regardless of whether it's a 5-minute bars or 10-minute bars, hourly bars, or actually weekly bars. The important thing is that the SMA divides Bollinger Bands to 2 zones, okay? Half above, as you can see here, for example, and half below the moving average. As we can see here, during an uptrend, price is moving in the upper half of the bands, and it's possible to see a lot of tags from the upper band, as you see here or here or here, and many more, while a very few or a none come from the lower band. You see, there is no touch of the lower band during an uptrend. On the other side, in a downtrend, we see prices moving in the lower half of the bands, and we typically get multiple tags along with the lower band. As you see, comes along with the lower band, but very few to none along with the upper band. It's actually the price has not touched even above the middle band during the downtrend here. Okay, so this is the main concept that we are going to use for today from the Bollinger Bands. Okay, are we clear, guys? Do you have any questions so far? Please just give me some feedbacks about that. Then we can go forward, maybe more confidence. Okay, good. Thank you. So let's see what are relative highs and relative low in terms of Bollinger Bands. It's crucial to remember that the 2 key concepts behind the Bollinger Bands are that price is relatively high at the upper band by definition, and price is relatively low at the lower band. So it means the relationship between the price and the band is more important than the relationship between the price and its history. Okay, Once you actually grasp those concepts, the rest makes sense, and then we can use it in our favor. So once more, being at the upper band means prices are high over the recent 20 periods, and being at the lower band means prices are low over the recent 20 periods. Okay, but let's move forward and see how we can just hire this Bollinger Band tool on our charts. As we mentioned, the Bollinger Bands, the default setting actually for the Bollinger Bands is the 20 period simple moving average as a middle band, and then we have the upper band, which derived by middle band plus 2 times the standard deviation, and then we have the lower band, which is a middle band minus or our 20 simple moving average minus 2 times the standard deviation, and all them together gives us the Bollinger Band. Let's jump on the MetaTrader 4 to see how we can put it on the on the chart. Here you see the Bollinger Bands under the trend indicator and the navigator actually window. You can add the Bollinger Band from here, or also you can use your insert menu indicators and go through the trend and then find the Bollinger Bands. Both the same. And here you see we can choose our period and deviation. That's a width, or that's variable number we use as 2 as default. And then keep in mind that we are going to apply all these calculation on the close prices. By the way, you can choose between different prices, but for now let's just stick with the default setting. And now if I press the OK, you see the 3 bands appear on the chart. So the only thing that we want to keep in mind is that when prices is in the upper half of the Bollinger Bands, this means we are in an uptrend, and when the prices are in the lower half of the Bollinger Bands means we are in a downtrend. And you see during a downtrend, prices shows an extreme relatively low, okay, right here, because prices are relatively low when they are at the lower band, and they are relatively high when they are at the upper band. For example, here let's go through some live charts, to make it maybe to give a better understanding of that. For example, here you see the Euro USD on a weekly basis, or the weekly chart, have that this week, last week prices were actually closed below the lower band, which means they are at their extreme low compared to last 20 weeks. And now they are trying just to recover from that low. If I go to the lower time frame, you see prices are relatively low and making a lower lows along with the lower band of the Bollinger Band. It means the market, the actually bearish sentiment is totally overcome, and the sellers are controlling the market along the time. Okay, this is the way that we can interpret the price action using the Bollinger Bands. By the way, there are some questions here maybe. The first is that which time frame would be the best one to use the Bollinger Bands with? The general answer is that you can use the Bollinger Bands in all time frames. Okay, because the thing that includes in the calculation is the period of bars, not the time frame. For example, when we have a 20 bars here, this is what we use to calculate the averages and also the bands. So it doesn't matter which time frame you are going to use it, but you have to notice that when you are going to use the Bollinger Bands or any other indicator in the shorter time frame, it means you are getting the more, let's say, the sudden emotion of the market, the most volatility you will get, or you will see some noises along with the price action. It means making these highs and lows here just reflects the present sentiment of the market in shorter time frames. And so if you want to find a more stable trends, or let's say the intermediate trends, is better to go through the higher time frame like a H4 or the daily time frame. For example, here you see on the H4 the prices just trying to get below the middle bands of the Bollinger Bands, and on the daily I see they are bouncing back from the from the middle band. Okay, it means we have prices in the long view, long perspective. We have them in the lower half of the bands, which means the sentiment is bearish. And also in 4 hours, we see the sentiment is turning to bearish by prices just actually dropping below the middle band. But and also in the short-term time frames, we see that. Yeah, but you see here, for example, in the short-term time frame like 15, we have the prices at the extreme low by attaching to this lower band. Okay, this is the difference between the different time frames that we can interpret them in a different ways. By the way, the most important things is knowing these two things. When prices actually are in the middle, on the lower half or the upper half, and when they are actually touching the lower band or the upper band. Okay, given that, let's see what is a classic W. A classic W is a bullish reversal that can be defined by Bollinger Bands. Okay, that's a very nice buy signal that can be generated from the classic W. So here is a classic W in terms of Bollinger Bands. Price would come down. Let me find my laser point, guys. Okay, where is it? Okay, here. See, the thing is that the price would come down, make a new low, as you see here in the picture, outside of the lower band. Please pay attention to this, and then rally back, make a new low in price. That's not a new low relative to Bollinger Bands. Why? Because we see the prices is closed just above the lower band. Okay, so W bottoms can be identified by Bollinger Bands if the second bottom holds above the lower band, while it can be lower or higher than the first bottom. Okay, so we don't care about the first bottom. We just see at the relation between the price and the lower band. So once more, W bottoms is identified by Bollinger Bands if the second bottom holds above the lower band, while it can be lower or higher than the first bottom. Price then pull back towards the middle band here, you see, yes, or higher, and creates a new bottom which holds above the lower band. When the price moves above the higher, this is our first bottom here, okay, this is our second bottom here, this is a higher low, higher relative low in terms of Bollinger Bands. And you see, we can just by connecting these tops and bottoms, we can just define a beautiful W-shaped pattern here. Okay, so price then pull back from here, yeah, towards the middle band or higher, and creates a new bottom here which holds above the lower band. When the price moves above the high of the first pullback top, as you see here, the W bottom is in place and indicates that the price will likely rise to a new high, which means our buy signal is triggered. And see, afterward, we can expect a big rally to actually begin. So this is a classic W. And how we are going to trade this classic W? It means when you actually identify the second higher relative low, as you see here, by breaking above the previous top of the market, you can find an entry point around that. In that case, you can put your stop loss just below the previous low or previous bottom of the market right here. Maybe you can give it buffer lower a bit. And notice this distance from the stop loss and entry that can be used to define to actually determine your exit point. This is only let's say this is your call, because the different traders use different risk management rules. So by the way, you can just determine your exit point by the 1-to-1 risk reward ratio, and then you can see you can get out here at actually when the price just hits your exit point. But it's very important to stick to your risk management rules because you have to put your stop loss as soon as you enter a trade, and then you have to have a decision on your exit point when you enter a trade. So you can use the different ratios, doesn't matter, but it's important to have them in advance. Okay, and then you can see at any of these points, we can just close our trade. So this is a very simple way of trading the classic W, but we will back to it in more details. Also, Mr. Bollinger uses M pattern with Bollinger Bands to identify M tops. In this simplest form, the M-top chart pattern is similar to a double top chart pattern. M-tops occur when a price moves close to or above the upper band, as you can see here. After that, the price pulls back toward the middle band or lower somehow, like you see here, making a new high, but it doesn't close above the upper band. However, it can be higher or lower than the previous high. It doesn't matter. If the price drops below the previous pullback low, we have an M top pattern. So we can identify a very beautiful M here, and then we have this lower relative top here because actually the price doesn't close above the higher the upper band. So as soon as the price gets below the previous low, it triggers a sell signal for us, and we can say that we identified the M top. So to identify these patterns, guys, please bear in mind that first you need to have prior trend. For example, you need to see the market is on rise or on drop. Okay, the first one. And the second one is that you need to see your relative actually lower top or relative higher bottom, okay, in terms of the Bollinger Bands. And then to confirm, we need a confirmation for our reversal pattern. To confirm your pattern, we have to see a decisive, let's say, close below the previous bottom here. Or when we are going to just identify a classic W, we need to see a very clear close above the market previous actually market top. Okay, so closing below this support level here can just validate our pattern here. And you see, along with that, we see the price just actually dropped into this below the middle line, which is the simple moving average. Okay, it means in a selling territory for us. Okay, so by considering these three rules or three implications, then we can have this nice classic M pattern here, and afterward usually we have the downward movement consequently. To trade the classic M patterns, you can actually find the entry point here after you see a decisive close below the previous market bottom, and then you can put your stop loss just above the previous top, and then you can just determine your exit point. Depends on your risk management rules. But by the way, here I just simply use the 1-to-1 risk reward ratio, and then you can just close your trade as soon as price hits your exit level or take profits level. Okay, and you can also use this type of a strategy to put on any different reversal chart pattern. But here, first of all, we need to clarify that everything that we are talking here is in a relation with the Bollinger Bands, in terms of the Bollinger Bands. Okay, let's see what is a percent B oscillator. That it makes it easy for us to find these types of patterns, these reversal patterns, by signaling a divergence between the oscillator and price. Okay, to get a precise sense of the relation between the price and the bonds, actually bands, Mr. Bollinger invented an oscillator called percent B. We can use percent B to determine whether we are in relation to Bollinger Bands. So here is the formula of percent B. It's the last price minus the lower band. So it's the distance from the closing price to the lower band, and that distance is normalized by dividing by the distance from the upper band to the lower band. It will be obvious to those of you who are familiar with technical analysis that this formula is derived directly from the stochastic formula. Mr. Bollinger used the value of upper band in place of the periodic high and the value of lower band in place of the periodic low, which we are using in the stochastic formula. But I don't want to make you confused about this mathematics and everything. I will put the both Bollinger Bands oscillators on the chart, then we can see how we can actually just use them, because what we need is the interpretation, is a correct interpretation of those oscillators. But now you can imagine what does it mean, because if you are a trader and you know the stochastic actually already, this is a very similar, it has a very similar formula to that. So on the MetaTrader, let me see, you can download, because they are not on the MT4 by default, and you need to download them from the, let me say, mql5.com. I have it almost ready here. You can just search it, and this is the Bollinger Bands percent B indicator for MetaTrader 4, and you can download it from the mql5.com. Okay, and also maybe the other website you can find them. That's free to download. And let's see, where can I find it to put it on the chart? This is the Bollinger Bands, 3B. Okay, when you are going to use this oscillator, you see this actual window pops up. First of all, we need to determine our levels. The levels are the 0, okay, as the lower band, and also we put the 0.5 and 1.0. So 1, 0.5 and 0 are the levels that we are going to use. And let me give them a color maybe to make it more clear for you to see. And then I'm going to change the color here as a yellow. I would like to change it to green, maybe that would be more clear for us. Okay, and then I put okay, and you see the oscillators just appears below the chart area here, and we are going to see how it works. And you see why the levels are a 0 and 1, the upper band and the lower band and the upper band, because you see here we have the upper band minus the lower band. That would be let's say variable for us. Okay, but we have also a closing price, distance of the closing price and the lower band compared to the lower band. So it means when we have the closing price just right at the lower band, it gives us the 0 for this calculation, and then the percent B gonna get 0. Okay, so let's see how we can identify the classic W using the percent B. Here's percent B, as you see below the chart area that I have, and this is the key to W bottom. Here we have made a low, rallied back, and we make a new low. that's a new absolute low in price, but it is not a new low or new lower bottom relative to the Bollinger Bands, okay, because this low actually closed above the lower band, okay. So now we come down here and look at the oscillator. As you see, the first low of the person B is in the negative territory below the zero. It means because the prices actually closed below the lower band, okay, so it's below the zero. And the second low percent B is it's above the zero because the price just closed above the lower band. And then we can identify this bullish divergence that initiate a subsequent buy signal for us if we find the confirmation from the price on the chart. Okay, so you can see if I just connect these lows of the oscillator and connect these lows from the price, we can see the very clear divergence between the price and oscillator. But here right now, as we are not going to use the low tops and bottoms in terms of price, but in terms of the bands. So we are not going to use the divergence. Okay, I'm just wanted to show you to see how this oscillator is working. The thing is that we are just going to see the upward percent B at the end of a downtrend. So this is a sign of the that indicates the price is losing its downside momentum. Okay, this is the only way that we are going to use it. And also we can use it to identify the M pattern. Sometimes it's a bit complicated on the chart to define a very clear and perfect and pure M shape. So in that case, if we use this oscillator, it would be very helpful. And we have a similar story with classic M pattern here. As you can see, the price has made a high outside the bands, and after a retracement made a new absolute higher high but a lower high in relation to bands. That we call it the lower relative top here. Yes, because it's closed below the upper band. So if we come down and look at the percent B, we can recognize the divergence that is considered as a sell signal, as a potential sell signal. And but again, the important thing here is that at the end of an uptrend or upward movement, we need to see the oscillator doesn't confirm the price rising. Okay. Which appears in terms of the percent B making a divergence, but there is a possibility to see the maybe lower low in terms of the price as well. That's why we don't rely just on the divergence. Okay, the thing that is important for us is to find a lower top on the oscillator while we see the prices are actually on rise. The next oscillator that I'm going to introduce today is the bandwidth oscillator, and the bandwidth simply tells us how wide the Bollinger Bands are. If you have seen my first webinar about the Bollinger Bands, I described the whole concept of the Bollinger Bands and the squeeze and the bulge and the interpretation of the bands when they are getting narrow or they are getting wide compared to each other, and how we can use them. By the way, here we can use the bandwidth as the oscillator that indicates the width of the Bollinger Bands, only the upper band and the lower band. Okay. In the other words, the bandwidth simply tells us how wide the Bollinger Bands are. Obviously, it's possible to compare it across time and from issue to issue, but it's especially relevant to compare it across time. So that is the formula of the bandwidth. You can see here the upper band minus the lower band and the result divided by the middle band. So this gives us a relative distance between the bands here, the formula. The distance between the upper band and the lower band divided by the middle band. Therefore, bandwidth is an effective way to identify trading opportunities, and you will see how we are going to use it. But yeah, let me back to my MT4 here and to show you how we can use this bandwidth oscillator. Once more, I also downloaded it from the mql5.com for free, and also you can search it on the internet and download it. I would also actually put my email on the chat at the end of the webinar. Then you can just send me an email if you need these oscillators, and then I will be happy to send it to you. Here we have the bandwidth. Let me find it on my MT4. Okay, this is a Bollinger bandwidth indicator, as you can see here on the under the navigator window. Let me change the color here again, maybe to blue, something like that, and give it a width of the 2 or 3 to have it more clear. And then there is no level, with this actually oscillator. And simply when you click the OK, you see this bandwidth appears on below the chart here. And let's see how we can interpret this. Okay. Earlier we learned about the Bollinger Bands in our previous webinar. That the big trading opportunities here is a squeeze. The core concept of the Bollinger Bands, the relation between the bands also, the squeeze, while other trading opportunities or the bulge. As a result, the squeeze is a trough this has been with a fairly low value in terms of bandwidth. It means it determines when we see the bands are too narrow, too close to each other. In that case, we can consider the squeeze happening in the market at the lowest actually volatility compared to the previous 180 bars, as Mr. Bollinger actually said. And a bulge, what is the bulge? Bulge is a forecast of decreased volatility when we see the bands are at the widest level again, compared to each other, okay? But it's more important to think of a squeeze as a beginning of something. There is a squeeze condition in which trends are born, and a bulge signifies the end of something. So this is how we are going to use them. We use this volatility measurement to see as the beginning and ending of the actually trend. Okay, so here you can identify a reversal. Let me find it in terms of the W bottom, as we discussed, and you can see the bands are in the narrowest distance from each other, as bandwidth is incredibly low in value compared to the history. Yeah, okay, clear? Good. So if we have a W pattern in a squeeze, and initial confirmation of reversal comes from the relatively higher low, and the second confirmation comes from the squeeze, and afterward move up in bandwidth, which means the volatility is increasing. If I zoom in a bit, maybe you can see it more precisely. We have a W bottom during the squeeze because we see that our second bottom is above the lower band, and then we get above our previous top here, and so we are in a squeeze. And then we see, along with the price action gaining some positive momentum, the bands are getting widened, and consequently we see the bandwidth oscillator is moving up, is picking up here. Okay, so this is how we can interpret the bandwidth in regards with the Bollinger Bands and also the price action. But please take note that our confirmation for W for this W pattern here comes from the break out upside the previous top. This is the confirmation, and we just use this oscillator uh, to get more actually confidence, about what we are seeing on a price chart. So you see, what we are doing here is building up pieces of evidence that increase our confidence, okay, to take a trade. There is always a possibility the market goes against us, but in this setup, we are risking very little, but the potential reward can be as big as the run to the upper band that we see has happened actually here. And here we can find another example about that. And you see, we also see here, for example, can be considered as a W actually pattern. No, because the oscillator here doesn't confirm it for us. Okay, I hope it's been clear to you guys. But to make it more clear, let me put them all together and just share and trading a strategy with you. Here is an example of putting all together for let's say the buy signal that we can generate from the Bollinger Band trading system. This is what we call the Bollinger Band trading system. We see a pretty downtrend here. Let me show you. Yes, and price makes a low out of the band that is reflected on the percent B by making a low below the zero. Okay, at the same time, the bandwidth shows the bands are narrow, and we have a situation of a squeeze that alerts we are at the beginning of a new new trend. Okay, so we can just wait to see the market action, then we can decide on that as soon as we identify, let's say, the squeeze on the market. So then forming a relative higher low is accompanied, as you can see here, with the increasing bandwidth and making the higher percent below above the zero. This is the second one. Okay, so to put it precisely, we have three conditions that should be met to trigger a buy signal. First, as you see here in the red line, the higher relative bottom in price, we need to evidence that, and then we need the higher bottom for percent B and increasing bandwidth. Put them all together. Once the price breaks above its previous top, some point here, yes, a buy signal is triggered. Now we know our entry level. We may determine the stop loss and maybe at the previous low, as we discussed before, with a buffer downside. That would be better. Maybe choosing take profit target is your call, guys. Okay, and totally up to your risk management preferences. We can choose to close part of the trade at the upper band. For example, maybe somewhere here could be our TP1 or our first take profit target. In that case, we can replace our stop loss to risk-free the rest of our trade. Okay, that will be another possibility for us. After taking the first target, yes, you can just move our stop loss to our entry point, and then afterward anything we get would be our profit, and our trade will be risk-free. We can choose to close part of trade at the upper band immediately and replace our stop loss to risk-free the rest, or we can use the bandwidth to come down in value and illustrate a situation of bulge, or simply follow a simple reward to risk ratio. There are three ways that we can just manage our trade when we find a W pattern here. So the first one is using the upper band as an exit point, okay, and the other one is using the bulge. It means when we see the bandwidth is at the extreme high of it at the peak, and then we can close part of our position there, or we can just use the one by one or 3-to-1 reward to risk ratio is here. For example, part of the trade at this level, and the part of that part of the trade at the TP2, and then we can close all the position at the TP3. Here we can have the 3-to-1 reward risk ratio, and also we can have it for this as a sell signal. Here is an example of again putting all together with these three conditions. What we see here is the price makes a top above the upper band that is reflected on the percent B by making a high above the upper band. At the same time, here you see this is a percent B and this is a bandwidth. Actually, maybe because the difference between this level of bandwidth and here is too much, so we can see it maybe very clear. By the way, it's a bit higher regarding to the previous data, is at the level of the squeeze as well, and that means the bandwidth shows the bands are narrow. Okay, then forming a relatively lower top, as we see here, is accompanied with the increase in bandwidth and making a lower percent B top below 1. As you see here, the first one is above the 1 level and the second one is below the 1 level. It means we have all the conditions ready and set. Once the price breaks below our previous bottom, we can put our stop loss there, and then we can manage our trade by using, this is a different actually a risk management rule. Okay, we can just use the Fibonacci level at the 144.4% or 168.1%. This is the Fibonacci projection, guys. And also we can manage a TP3 at the 200% or let's say 2-to-1 risk reward ratio, which this is the 1-to-1 actually reward to risk ratio, guys. Okay, so this is another way to manage your trade. Thank you so much, take care, and I hope to see you in our next webinar next week.